If you're looking to purchase a home in today's market with the interest rates the way they are, you may want to look at adjustable interest rate loans. Why? And why you should be cautious? Well, let's talk about that right now. I'm Sandy Curtis with Berkshire Hathaway Bowen Realty in Hagerstown, Maryland, and today we're discussing adjustable interest rate loans. If you're a buyer in today's market and you have been pre-approved for a loan, you might be well aware of how the interest rate can affect how much you can purchase. If you were previously pre-approved in the past few months, then you may have been quoted an interest rate below 3%. But right now, we're all aware they did a giant hike and we are over 5% now. That percentage rate can cut into how much you can purchase by so much. You're going to want to talk to your lender to find out how that new interest rate is going to affect your payments and how much home you can afford to purchase. So what's the alternative? Well, there's a couple. You can have a lot of money to put down and have a lower loan on the home, but we're not all in that kind of position. So the other option would be possibly to look at an adjustable interest rate loan. This type of loan is going to give you a low interest rate for the first, say, 5 years. It depends on the loan that you are looking at. Some of them are 1 year to 3 year, up to 5 year. And keep in mind of what type of adjustable loan you have, because it is going to depend on whether that interest rate is adjustable on a yearly basis and how much of a cap it would have going up or going down. To understand a little bit more about how they work, they're going to give you an introductory rate. So let's say they're going to say the first year of this loan you're going to have an interest rate of 2% and your payment's going to be X. But during that year, it is adjustable depending on how prime rate moves. Let's say your interest rate is 2% and it adjusts by another 3%. Well, that would make your interest rate 5%. However, you have a cap on how much that rate can be raised in any given year, depending on what that cap rate is, 1 or 2 or 3. So if rates have gone up and your adjustable rate is going to be affected, how high could your interest rate go based on your loan financing? You're going to want to make sure that you clarify that so that you know what is going to happen at any given point during the adjustable rate period. So that example gave our beginning rate of 2% and the interest rates have gone up another 3, but you have a 1% cap on your loan, so that would make your new interest for that year 3%. And yes, if the interest rates go down, it can also affect your adjustable rate in a good way. It can bring your interest rate back down. The main key to understand about an adjustable interest rate type loan is that when that period is up, your interest rate is going to go to whatever the normal interest rate is at that given time, or whatever your loan specifically says. So let's say that you have a 5-year adjustable rate mortgage. That means the first 5 years, each year, your rate can be adjusted depending on where the rates are at that given time, with a cap of how much it can go up or down during that given year. At the end of the 5th year, that means you're going to go to a fixed rate, and you need to know what that rate is going to be. Is it going to be what it currently is right now, or is your fixed rate going to be based on that future interest rate that we will be at in that 5-year period? The reason for doing an adjustable rate mortgage is because it can help you afford more home than you would otherwise at a higher interest rate, giving you a little bit more buying power. It can also get you a lower mortgage payment during the first however many years of that adjustable rate. Let's just assume it's the 5, so that would give you 5 years of lower monthly payments on your mortgage. But you have to understand at the end of that 5th year, those rates are going to go up and your mortgage payment is going to go up, and you need to budget for that now. Another reason to use an adjustable rate mortgage, let's say that you have a lot of funds that you can put towards the house and you'll only be mortgaging a small amount. An adjustable rate mortgage will get you a lower monthly payment on that amount, and it'll give you that amount of time. However, the adjustable rate is for, let's assume, that 5 years. That'll give you 5 years to refinance that loan at a better interest rate that could be fixed for you. Just remember, every time you refinance a loan, you may be saving money over the long term, but you're also paying the lender that you're refinancing that loan through. That loan may actually be costing you the exact same amount of money that you would be saving by going on to that loan. So what would be the point of doing that? Because when you refinance the loan, most of us go again with that 30-year mortgage, which just tacks more years onto the end of it, and you're going to be paying for that house for forever. Or at least it's going to feel like that. If you don't have to refinance, I don't recommend doing it. It's money out of your pocket that you could be putting into the home or saving to put towards your next purchase. So we've talked about the benefits of why you would want to do an adjustable rate mortgage. Well, let's discuss why you wouldn't want to do an adjustable rate mortgage. Never assume that you're going to get a pay raise. Life happens. Things that we don't plan for happen. Divorce happens. Death happens. Illness happens. And there's a reason that you're going to want to owe less on your home if you get into a position where you have to sell it. The more equity that you can build up, the better. If you are purchasing a home with the maximum amount that you can borrow and you're going with an adjustable rate mortgage, then I do not recommend doing that. Reasoning, because you're already at the maximum of what you can borrow based on that. And when that time period ends for that adjustable rate, your mortgage is going to go up. It could even double depending on how much you borrowed and what the interest rates change to. You have to budget for an adjustable rate mortgage. Do not get surprised by it, but when it happens, just understand that an adjustable rate mortgage is an adjustable rate, and it's adjustable yearly for X amount of years based on whatever loan type you're getting. Again, our example previously was for 5 years. So that is 5 years. Each year, your adjustable rate can change up or down during the year, and it will affect your monthly mortgage payments. But at the end of that period, that 5 years, when that is over, your mortgage payment is going to change tremendously because your interest rate is going to change tremendously. Make sure you understand what you are signing for when you get an adjustable rate mortgage. Just understand, adjustable rate mortgages can be dangerous if you are not planning or paying attention to what it is that you are doing with that loan. Have a budget. Know what's coming, be prepared for it. If you need to refinance before your 5th year, get working on it. I hope that covered concerns that you may have or questions you may have had about what an adjustable rate mortgage is and how it can affect you. I'm Sandy Curtis, and I will see you on the next video. Thanks for watching.